Hey everyone, welcome back to the channel. First of all, I want to celebrate that this channel has crossed the 100 subscribers milestone. It's no big deal in the YouTube world, but it's a big deal to me because 100 of you chose to subscribe and listen to a dude like me sharing my income journey. So thank you very much. Now I'm recording this video on the 5th of February. Let's start by looking at what's happening in the markets right now, because I think the price action itself is already telling us an important story. Over the past few weeks, we have seen the Nasdaq being sold off quite aggressively. Tech stocks, especially high growth, high multiple names, have come under pressure as investors reassess valuations, earnings expectations, and how much optimism is already priced in. At the same time, if you look at the S&P 500 and the Dow Jones, they are actually holding up relatively well. They haven't collapsed in the same way as the Nasdaq has. Now that tells us something important. This isn't a full market panic. This looks more like rotation. Money is rotating away from high beta growth, long duration tech, speculative names, and into more stable businesses, cash flow generating assets, defensive parts of the market. Now let's talk about Bitcoin. Bitcoin has also plunged quite a bit recently, dropping sharply from its highs. As I'm recording this on 5th February, Bitcoin has fell to a low below 61,000. And that's not surprising. When markets turn risk off, crypto tends to feel it even more. You get forced liquidations, sentiment shifts, and a pullback from speculative assets. So when you step back and look at all four charts together, Nasdaq, S&P 500, Dow, and Bitcoin, the message is pretty clear. Investors are becoming more selective. Cash flow and stability are starting to matter more than hype and momentum. For me, I've also recently cashed out US $11,000 from my Moomoo account. It was in a money market fund previously. I cashed out because I want to deploy the money into my interactive broker account to continue growing this account. This is where my main investment lie. This 11,000 will be used as dry powder for opportunities to scoop more assets when they have further discounts. Now, after talking about the recent market moves and sentiment, I want to talk about a sector, and that is real estate. Where does real estate fit into this kind of environment? Now, real estate hasn't been ripping higher, but compared to tech and crypto, real estate has actually been relatively consistent. And that makes sense. Real estate is backed by physical assets, driven by rental income and leases, less dependent on rapid growth narratives. In a market where growth is being questioned, volatility is picking up, and capital is rotating, income-focused real estate strategies start to look more attractive, especially if you are not chasing capital appreciation. Which brings us to today's ETF that I want to review. Now I'm going to take a proper investor level look at IYRI, the newest real estate high income ETF. It is not a new ETF, it has been around for quite a while now. Now this is not a buy or sell now recommendation. This is about understanding what IYRI actually does, where the income comes from, and whether it makes sense in today's market environment. And as always, this is not financial advice. Everything I say here is for entertainment and educational purposes. Please do your own research and invest based on your risk tolerance. Like this video and subscribe to the channel if you have not done so. Alright, let's move on. Now let's be very clear. IYRI is not a traditional REIT ETF like VNQ. Instead, it does two things. First, it owns a portfolio of high quality US REITs, large, well-known names like Prologis, Welltower, American Tower, Realty Income, and Digital Realty. Many of these names are paying a decent dividends on its own. Second, on top of owning these REITs, it sells call options on them. Those option selling strategy is what boosts the income. When you buy IYRI, you're not just buying real estate, you are buying real estate plus an option income strategy. That distinction is critical. To understand why IYRI exists, we need to talk briefly about the macro backdrop. REITs are very sensitive to long-term interest rates, not just Fed cuts. Even when the Fed start cutting short-term rates, long-term yields can stay elevated due to inflation expectations, government borrowing, structural supply and demand issues. As long as long-term yields remain high, REITs borrowing stays expensive. Valuations will stay compressed and the price upside remains limited. So realistically, the outlook for REITs right now looks like modest income, sideways price movement, and limited capital appreciation. And if that's the case, then waiting for REITs prices to save your returns may not be the best strategy. Now let's examine where the yield comes from. IYRI currently pays monthly income with a trailing yield of around 11%. That yield does not come purely from REITs dividends. A large portion comes from selling call options. Here is how it works in simple terms. IYRI owns REITs stocks. It sells call options on those holdings. Option buyers pay premiums. Those premiums are distributed as income. This allows IYRI to turn a sideways asset class into cash flowing producing one. Now here's the distributions from the whole of 2025. As you can see, the range of the distributions is between 44 cents to 51 cents. The monthly dividend amount can fluctuate slightly, and that's normal. This is not a dividend growth investing. This is income harvesting. One thing I like about IYRI is that it's not chasing weak or distressed REITs just to inflate yield. The portfolio is concentrated in large cap, investment grade, cash flow generating REITs. This matters because high quality underlying assets help stabilize NAV. Options works best on liquid, established stocks. So structurally, the foundation of the ETF is solid. Now let's talk about the trade-off, because there is one. When you sell call options, you give up some upside. If REITs suddenly rally hard, IYRI will not fully participate. Gains are capped by option strikes. But in exchange, you get high income, more predictable cash flow, some downside cushioning from option premiums. This strategy makes sense only if you believe REITs are likely to stay range bound. And given the current interest rate and macro environment, that is a reasonable assumption. Now if you look at IYRI's price chart, you'll notice it trades mostly sideways. This is not a failure, this is the design. Covered call ETFs are not built for capital appreciation. They are built to convert volatility into income, reduce emotional stress for income investors. So if you're buying IYRI expecting growth, you'll be disappointed. If you buy it for monthly cash flow, it behaves exactly as intended. Now, so who IYRI is for? It makes sense if you are an income-focused investor, retired or near retirement, looking for cash flow over capital gains. It is not suitable if you are a growth investor, expecting a REIT rebound, trying to outperform the S&P 500. This ETF is a tool, not a bet. Personally, I will treat IYRI as a satellite income position, not a core growth holding. It can sit alongside cash-like assets, other income ETFs, bond or bond substitutes. The key is role clarity. You buy IYRI for income. As always, there are risks, and I'm going to give you 3 key risks. The first risk is a prolonged downturn in REITs themselves. Even though IYRI is designed to generate income, it still owns real estate stocks underneath. If REIT price falls sharply and stay depressed for a long time, the net asset value of the ETF will decline. Option premiums can only cushion losses, not eliminate them. Future income may become less stable if volatility turns into persistent weakness. Covered call provide income and partial downside buffering, but they do not make the fund immune to sustained bear markets. This is why IYRI works best when REITs move sideways or experience shallow, choppy declines. It works less well during deep real estate recessions, credit stress events, prolonged periods of rising long-term yields. So the risk here is not a 1-month dip, it is a long multi-year downtrend in real estate. The second risk is more subtle, but just as important. IYRI relies heavily on selling call options to generate income. And option premiums depend on market volatility. When volatility is high, option buyers pay more, premiums are richer, income distributions tend to be higher. When volatility falls, option premiums shrink, income can drop even if prices stay flat. This means IYRI's income is not guaranteed. Monthly payouts can fluctuate. In a very calm market, yield may compress. So paradoxically, a very stable, low volatility market can actually reduce income from covered call ETFs. This is why you should never think of the yield as fixed. It is market dependent. There's one more risk that doesn't show up as a loss, but it matters. That's opportunity cost. If REITs suddenly enter a strong bull market, IYRI will lag, gains are capped due to call options, you may underperform traditional REIT ETFs. This is not a flaw, it is a price you pay for higher income. So this ETF is not about being right on REIT's direction, it is about realistic about what kind of market we are likely to get. Now the key thing is this, these risks are manageable if you size the position properly, you understand the role of IYRI in your portfolio, you don't expect growth from an income product. So IYRI is best viewed as an income generator, a volatility harvesting tool, not a capital compounding engine. If you accept that upfront, the risk become known trade-offs, not surprises. So here's the takeaway. In a market where tech is volatile, crypto is correcting, growth expectations are being questioned, IYRI offers a different approach. It doesn't fix REITs, it changes how you extract value from them. If income and stability matter more to you than upside, this is the tool while understanding. Now let me know in the comment section below. Do you currently own REITs, or would you consider something like IYRI for income? If you found this breakdown useful, give a video a like, subscribe to the channel, and I'll see you in the next one.